Well, welcome everyone. Thank you for joining us for the BODC Multifamily Impact Fund webinar. So we'll go through our deck and answer any questions you may have over the next 30 minutes going over the deck. Then we'll probably allow about 15 minutes for Q&A. We're going to show you why, um, how we de-risk deals. We're not going to show the highest IRR, but I'll let you know we're not gonna the operators that do cash calls and run into problems because we de-risk. We're not about flash and the highest IRR. Those are the deals that will get you into trouble. Um, we're also going to show you why now is actually a really great time to invest, and why we think our first deal in the fund is a phenomenal deal. So a quick disclaimer, this is neither an offer to sell nor a solicitation of an offer to buy the securities described herein. An offering may only be made by a private placement memorandum to which this investment summary is attached as an exhibit. You should read the private placement memorandum, including each of its exhibits in their entirety, in order to understand fully all the implications and risks of the offering of securities to which it relates. An investment in the property should be made only after careful review of the private placement memorandum. The investment summary includes forecasts, projections, and other predictive statements based on assumptions and expectations made by the manager in light of currently available information, historical property performance, industry trends, market conditions, and information provided by the seller. The property's actual performance may differ from these projections based on factors outside of the manager's control. Moreover, past performance is no guarantee of future results. Therefore, no guarantee is presented or implied as to the accuracy of specific forecasts, projections, or predictive statements contained herein. So, company overview. For those that don't know us, I'm Gary Lipsky, president of Break of Day Capital. We acquire underperforming multifamily properties in high growth markets in the Southwest by implementing strong repositioning strategies and best in class asset management. We were recognized by the AAOA as the best real estate syndication company in 2022. They have over 143,000 members now. We were also recognized by Inc. magazine as the 25th fastest growing real estate company. That's not necessarily a goal of ours. We focus on quality over quantity, but it's still we're really proud of that award. We've done a $250 million in the last 4 years or so in Arizona, and we currently manage 7 multifamily properties and $182 million of assets under management. Our mission is to provide passive investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while improving the quality of life and community for our residents. So we create win-win scenarios for our investors and for our residents. And for core values, I just want to point out Kaizen. A lot of people don't know what it means, and it just means constant improvement. And that's how we look at all of our properties. We're constantly improving the property. We also look at it internally as well. How can we improve as a company? How we send out investor communications, every little thing that we do, how we underwrite deals, we're always looking for constant improvement. A little bit about myself. I've been investing in real estate since 2002. Been an entrepreneur really my whole life, running companies. I wrote the best-selling book, Best in Class. I think it's the only book out there on asset management. And it's funny, this past weekend, a couple friends texted me a picture that they had it up on the big screen at a conference. They were talking about the book to all the attendees. A previous company that I had, we worked with 9,000 students on a daily basis and had 90 schools that we're working with daily. So that was like 90 properties we were managing. And I founded a nonprofit organization in I think 2006, and we ran it for about 15 years, and unfortunately had to shut it down a couple of years ago.
Hi guys, I'm Joe Fang, Director of Investor Relations. I have over a decade of experience in the traditional investment management business, having spent time at a long-short hedge fund in New York City, and then 7 years with a large global institutional fund manager in Los Angeles. I've also been an active real estate owner operator for over 20 years in Southern California. In recent years, I've also invested in close to 60 commercial real estate syndication deals with different sponsors, all up and down the capital stack. To my right, Eric, he's the acquisitions and asset manager. Together, we make up the investment committee for Break of Day Capital, along with Gary. Eric has pretty much spent most of his career on the institutional side. Most recently, with a large publicly traded REIT focused in the medical office space. This is the rest of our team. Jacqueline Bromagen. Many of you guys will probably interact with her. She's our operations manager. She's basically the glue that holds the whole team together. She's responsible for all the investor portal and the communications, and basically just helping our investors get their documents done. She's a research analyst with us. She does a lot of our special projects. Neil's our transaction attorney based here in Arizona. And then Rob is the CEO of Scotia Management. This is a boutique specialist property management company that focuses on the type of asset class and the markets that we're in Tucson.
And I'll add one, we hired a director of operations who will be joining our team next month as well. All right, so asset management, this is one of our secret sauces. We didn't start talking about it in the last 6 months like a lot of other people. We've really honed in on it. I was using my skills from running my other businesses and brought it to our real estate deals. I've interviewed over 150 experts on this exact subject on our podcast. It was originally called Real Estate Asset Management Podcast. We've since changed the name to Real Estate Investor Podcast and kind of broadened our reach. Our other secret sauce is our market expertise. So we're not doing the shotgun approach where we're looking at cities all over the country. We focused on a few cities where we can have thousands of data points, have really good broker relationships, and when a deal comes to market or before it comes to market and they send it to us, we know right away whether it's a good deal or a bad deal based on all of our other data. Now, we certainly underwrite it, and we do all of our due diligence. We want eyes on the property, but having that market expertise really gives us a leg up over others. And people often pass on deals because they don't know the market, what we can do there, and we'll see value, a lot more value in deals than others, and I'll get into that a little bit later. So in the states that we look for landlord and business friendly, sufficient MSA size, and that allows us to have a good workforce base. Like we need good staff, and if you're in a small MSA, it's going to be hard to find good quality staff, and that's why we want a sufficient MSA size. We also look for population growth, job growth, wage growth, and lower cost of living. And Tucson, our first deal in the fund, is one of the lowest cost of living cities in the country. So best in class value add strategy. We've averaged over our portfolio a 40% increase in NOI the first 12 months of holding a property, which is something that we're all really, really proud of. So if the property had an NOI of $1 million before we took it over, by the end of 12 months, that NOI is now 1.4 million. And what that means is if you take a 5 cap and divided it, that property is now worth originally 20 million, now it's worth 28 million. So we've added $8 million if we bought a $20 million deal across our whole portfolio. So really proud of that. We typically rebrand the property. So our first deal is the place at Spanish Trail. It will now be called Icon on Spanish Trail, which is Icon. We use that moniker at almost all of our properties. We do exterior renovations, interior renovations, and operations. So on this property, I'll get into it a little later on what we're going to do, but we look at all different facets at a property to see where we can improve, where we can add value. So this is one a property that we've done some exterior upgrades. You can see the massive transformation. It doesn't cost a lot of money, and we've massively transformed the property and been able to really drive rents $300-400 because of the updated property and the renovations that we make. So massive transformation, and most of the residents stay. They see that we're adding value and that they're going to have to pay more for less somewhere else. So we have a remarkable rate of renewals at our properties. Here's some interior renovations. The first column is a unit renovation. The second column is our our leasing office, and you really can't tell from the picture, but where I'm standing right above, we raised the ceiling 18 inches, obviously new flooring color, but it really opened it up, had a nice new look. And so those first impressions are so important when someone's coming to lease a property and we can add some like wow factor, they're gonna feel really proud and wanna live there. On the right, you've got the clubhouse renovation. We added the nice kitchen amenity so that residents can take advantage of it. It's a party space. We can have monthly functions in there for our residents. So really much more functional room than what it was. We've had 3 full cycle exits, averaging 61% IRR. Now, certainly that was during a really great time to sell, but we also picked the right city, we picked the right property, and we executed the heck out of that deal and sold it at the right time. I know friends that have held on to their deals way too long, and their IRR is now closer to 15% versus taking advantage of locking in those gains. Like I said before, $250 million in real estate transactions, no capital calls. We've done 2 adaptive reuse projects, and that's really showing how we look at value. And one was a student housing deal. The broker didn't think we'd want it. This was during COVID. We bought it. It was like 52% occupied. By the summer, this was February, we bought it. By the summer, we were over 90% occupied. And so we've doubled the value of that property. And it's been cash flowing nicely for a couple of years. And we are going through a refinance right now on that property to pull out cash. Our other adaptive reuse project was garden office space that we bought in Phoenix, and we got 44 units at the existing build, and we're almost done with about 60 new units on that property too. And so we're leasing up right now, and that'll be another home run. And we've distributed over $23 million to date. Here's our portfolio of the deals that we've bought, we've sold. I'm going to pass it over to Joe.
Thank you, Gary. So why are we investing in multifamily? So we start with a larger big picture approach. You identify, as professional investors entrusted with people's hard-earned capital, you really need to start with the big picture and then understand demographic trends and macro trends that are as inescapable as gravity, and start there. And so what we've noticed is, and then this is probably not a surprise to a lot of you guys, is that the Fed has to continue to print money or bring interest rates down whenever there's any kind of economic trouble, and it seems like we're about there again. And then what they do is that they overdo it, over ease, like they did in 2021, 2022, and then they're going to have to pull back all the liquidity, rapidly raise interest rates, and then take back, shrink the balance sheet as quickly as possible. So what happens is you have this yo-yo effect, just putting us through these mini busts and booms. We go through these periods of, inflation and a quick recession, and we just go back and forth. So how, as investors, and then also in, investing other people's money, how do we navigate through these kind of rough waters? And this is not gonna, by the way, guys, I should tell you that this is not going to change. This is going to be a common theme over the next decade, as the Fed continues to try to salvage the broken financial system. And they really don't have a lot of tools to keep the system afloat. So we've identified real estate, specifically workforce housing, as one of the best ways to express that point of view. Because real estate is a hard asset. It's when the Fed is engaged in money printing, you really want to be in assets that are hard, that are hard to create, or very difficult to create, and so all the value gets accrued, to hard assets, right? In addition, workforce housing, affordable housing, it's probably not surprising that there is actually a significant shortage. You just cannot build, affordable housing in today's market with the higher debt, or I should say, there's debt, but the higher labor cost, as well as material costs. So developers are having to build, luxury Class A stuff just to earn a respectable return on their capital. And so this additional demographic trend of a lack of affordable housing, and I've seen estimates from as low as like 1.5 million units, all the way to as many as 25 million units. So regardless of what number you want to believe, it's a big number, right? And that sticky demand is not going to be satiated anytime soon. And so we really love multifamily because it's not only is it recession resistant, but it's also a great inflation hedge. And then you have the demographic trend, the shortage of affordable housing supporting you. So there's no reason to really look anywhere else. This is really where you want to be over the next decade or longer. And you can see here on the graph on the right here, this is a research that was done by Origin Investments out of Chicago. And you can see what they've shown here is that over the last 3 major recessions, including the Great Financial Crisis, private equity real estate actually did better than safe havens like the 2-year US Treasury. So the fund, basically in a nutshell, you're getting the same expertise in asset management and operational operational expertise with break of day capital, but we want to repackage it so that you have a little bit more diversification in multiple properties, kind of minimize the dispersion of cash flow more. You're gonna just get 1K1. You only have to sign 1 subscription agreement, 1K1, but having your money exposed to multiple assets and all of the same benefits, whether that you get from a single asset syndication, which is what we've traditionally done. You're going to get all the same benefits, the cost segregation, the bonus depreciation, and also we're also waiving the fund management fee if you come in over the next 60 days. So this is not too different from what we've done over the last several years. Well, we really like the Southwest growth markets. We like units that are 100 units or greater. There's much better economies of scale when you go larger. We want, kind of the late 70s and newer build. Traditionally, we focus on Class B and C multifamily, where there's a value add component where we can actually force appreciation. But we will look at Class A properties on a case-by-case basis if we can get them at the right price. The leverage that we're putting on these properties is fairly conservative in this kind of the 60 to 75% range. I believe for Spanish Trail, we're kind of like in the mid to high 60s all in. Again, cost segregation, bonus depreciation. Gary, if I remember correctly, we're kind of in the 70s, right, for this particular deal.
Yep. Yep.
Okay, so here's a little bit more about the fund. We're targeting acquiring assets between 75 to 100 million dollars, kind of the 3 to 5 million, or sorry, 3 to 5 properties, and it's about a 30 to 50 million dollar equity raise. The fund will have a 4 to 6 year life, and then there will be 3 different investment classes, which we'll go into in the next slide. This is a 506C offering, so it's for accredited investors only. We're targeting kind of the 13 to 18% IRR, and we will be taking, we can accept cash or IRA money. And basically, in a nutshell, this is a closed-ended fund where we're going to be acquiring 3 to 5 assets, or we're going to close the fund in 1 year or less, whichever comes first. And so we'll be calling capital, the good kind, no, not the bad kind. We'll be calling capital as we acquire quality assets, but just be prepared that we may be calling all of the money at the time that we acquire assets. And so here's a little bit more about the different investment classes that are available. So Class A is preferred equity, and what that is a fixed 10% return with no additional upside, and there's also no depreciation benefits. The upside on this class is that this is great for somebody who wants a cash flow. It's going to be the distributions will be made on a monthly basis. Class B and C are what typically most of us will be investing in. Class B has a 7% pref. Then it's followed by a 70-30% split in favor of investors, to a 15% IRR, and then it's a 50-50 split thereafter. The distributions will be on a quarterly basis and expect up to 80% in depreciation. Class C is very similar to Class B, but it's really made for our institutional partners, and that has an 8% pref, and then followed by an 80-20% split in favor of investors. Same thing, quarterly distributions, bonus depreciation in the up to 80% range. I should mention that when investors will get their capital back first, followed by the pref return before the sponsors participate in the profit sharing. So our alignment or our interests are perfectly aligned.
And we should add that as a team, every single person on the Break of Day team is investing, and that'll be about at least 1.25 million into the fund.
So here's a kind of a projected returns of what $100,000 investment will look like over the 5-year holding period. You can kind of see, with value-add deals, you don't expect to see a lot of cash flow in the first year or two, because, as you renovate units, you're transitioning people out of classic, to, the new premium units, and there's going to be turnover and probably economic vacancy. And so to be conservative, you're not expecting to see a lot of cash flow in the first couple of years. And as the units, as we reach stabilization, as the rent bumps and then the NOI increases come in, then you'll see that over time the cash distribution go up, to sort of the mid single digits, maybe even the high double digit, or I should say high single digits. The last few years, the market has been, in addition to the forcing appreciation, because the market has been so favorable, we took advantage and exited, opportunistically. And so we never really got to year 3, 4, 5, where you saw a lot of cash flow. We were, able to exit at very high IRRs. Again, this is kind of an overview of the fund. So as I mentioned earlier, there's an investment period of 1 year. And so we're going to acquire 3 to 5 assets, or we're going to close the fund after the 1 year anniversary, whichever comes first. That will be followed by the renovation phase, where we're going to be executing on, some of the stuff that Gary mentioned earlier, where, we're going to be upgrading amenities, adding amenities, or upgrading units, and, executing on our business plan. And then as we get, into years 3 to 5, 3 to 6, we will be optimizing the property to get it ready for sale, with the market, hopefully with the market cooperating. We have deals, we have assets right now that are just, Gary can help me out on this, right? You're probably achieving anywhere from $400 to $600 above, our uh, um, the rents that where we took over the properties by. But unfortunately, with interest rates so high, people aren't able to pay the value that we have driven, and so we're gonna have to wait for for a more opportunistic time to exit. But we'll just be, as we get into that part of the investment cycle, we will be fine tuning the properties, try to tweak the occupancy a little bit more, or to increase the occupancy more, increase the NOI more, just whatever we can to kind of put the finishing touches. And then finally, as I mentioned, we'll be exiting at the most opportunistic time possible.
Yeah, we're always pulling different levers to increase the NOI. We've just added preferred parking to some of our properties. Now, we can't do everything all at once. It's just overwhelming for the property management company. So we do the big levers first, and then we start doing the little levers over time. That was something that we recently implemented. But yeah, like Joe says, we get the property perfected to that opportune time to sell and maximize. So I'm going to talk about our first deal in the fund, this place at Spanish Trail. As you can see, beautiful property, 256 units, so institutional grade, B-class property. And we're buying it at just under 135,000 a door. A recent comp, the Vistas at Fort Lowell, sold for 149,000, just under 149,000, and it's a C minus property with 57 units. So you're talking, it doesn't have any economies of scale, not nearly as nice of a property, and that sold for quite a bit more. We also walked a comp a few weeks ago. It was 175 a door, and this was a property I probably wouldn't pay 125,000 for. It was nowhere near as nice as Spanish Trail. So we really feel good about the cost basis that we're buying this at, and know that we have a few things that we can do to the property to really jack up the value. So we're gonna reposition 40 of the remaining classic interior units and upgrade them. Um, they also have, I'll show you on the next slide, they don't have any low flow toilets. And so what that means, actually, let me jump ahead and I'll come back. Um, when they flush a toilet, it's 3.5 gallons per flush. And with the new toilet, it's 0.8 gallons per flush. So massive difference. We also put aerators on shower heads and faucets. So the cost to install is 55,000 after rebate, which is nothing. But we're going to save, according to this, $138,000. This is actually the low estimate from the plumber. We also have a much higher savings. This doesn't account for, also, we're going to take away some of the grass and add turf, which is more water savings. But we didn't build all this water savings into our pro forma because we'd rather under promise and over deliver. But if you take this water savings and divide it by the cap rate, what we've done is create almost $3 million of value from day one because we can get this installed within 6 days. So once we're close to taking over the property, we'll get on the calendar for the crew to come, and they grind it out really quickly, and boom, we start seeing the water savings pretty quickly. So massive value to be had right from the beginning. They also have an extra staff person in the leasing office, which we really don't need. We've run many properties, and um, we don't need to have as much staff as they have, and it won't affect the quality of the asset. Now, because that's the most important thing. We wouldn't want to save money at the detriment of the property, but we feel strongly that We don't need an extra leasing person. So we would have 3 people on the inside, which is a property manager and 2 leasing agents, and 4 people on the outside, maintenance tech, housekeeper, and uh, well, maintenance supervisor and 2 maintenance techs. So 7 staff for a property this size. We also own 3 properties within 5 miles of this property that are performing well. And the seller recently put in almost $3 million to fixing up this property. So, like I said, a tremendous opportunity. Let me talk about the loan real quickly. It's 63% LTV and then another 6% for the CapEx. So combined, it's 69%. It's 3 years fixed rate. And we got this loan. We underwrote about 20 different loans. We model everything out because we want to find the best deal, the best loan that matches our business execution. Because if we're putting 7-year debt on it, 10-year debt, and we're looking to sell within a couple of years, it doesn't make sense. Even on a 5-year, the prepayment penalty is at least $1.5 million, could be 2 million or more. We've sold a deal in the past in 2 years, and we paid a $2 million prepayment penalty, which was not great, but we doubled investors' money. Okay, this loan makes a lot of sense. We've worked with this lender before. They're easy to work with. There's minimal fees, and they're quick to docs. So that's why we chose this loan. This made the most sense, and it's a little higher rate, but which is great. If you're concerned about rates going up in the future, which I'm willing to bet a lot of money that it's not, we're protected. If we want to refinance in a couple of years, we're protected. If we want to sell in a couple of years, we're protected. So we got a lot of different options. And that's why I like this loan. Just so you know a little bit more about us, we donate every year to a bunch of different causes, and these are some of the causes that we've donated in the last year. Um, Here's some testimonials. We'll send the deck out. I don't know if you need us to read any testimonials, but what we're really proud of is our investors come back time and time again and bring a friend because they like what we do. We do it the right way. We communicate clearly, often. We don't just say this is going perfectly. Nothing in life goes perfectly. So we talk about if we're struggling with anything, hey, we just had a tree fall on a unit, one of our properties, we'll communicate that. So full transparency from us all the time.
Gary, if I could jump in,
Yeah.
there are operators out there struggling right now. I mean, it's no secret. And what happens is that they go dark on our investors or on investors, right? Because we're invested in some of those bad deals from years ago, and it's quite annoying when they go dark on you and not tell you what's going on, and it just gives you a lot of anxiety, right? So we I want to take a moment and kind of share with people like how much we value communication, and the way that we do things is, we always communicate, we over communicate, we're fully transparent, the good, the bad, the ugly, and it goes out on the 19th of each month. During COVID, everybody was nervous, and so we actually upped our cadence to 2 times a week. And so, when things get tough, they will get tough, or they have been tough, right? As somebody who's done this over 20 years, having gone through multiple cycles, I know what it's like, when things unexpectedly, go south, right? So it's just a matter of investing with an operator that can take a punch, that knows how to work around obstacles, or deal with obstacles, and then not be scared and embarrassed, or whatever the word is, and basically tell our investors what the issues are, because they will come, and how we're dealing with it, and that your money is in good hands. We will go above and beyond to protect your capital.
Thanks, Joe. Next steps here, if you can go to our investor portal and you can watch the recording. We'll have this up by tomorrow. You can see the deck. We've got a video of the property. Happy to answer any calls you have. Any questions you have right now. And certainly, if you think of more questions tomorrow, next week, Joe and I are there for you to answer any questions you may have. Jacqueline is there for you to walk through any paperwork issues. She provides concierge service, so she'll be happy to help you, because I know when I've invested in other people's deals, I'm like, wait, how do I do this? Like, it's, if you don't do it on a consistent basis, I know it gets confusing. So we're happy to help you. But you can put your questions in the Q&A, and happy to answer anything that you may be wondering about.
Well, Gary, while we're waiting for questions, let me just add to our webinar today that besides being in the trenches with our property managers, making sure things get done, we also spend a lot of time diving deep into macro, and also understanding, developing a deep understanding for real estate cycles, because things, people always say, history doesn't really repeat itself, but it often rhymes, and that is absolutely true, right? The reason why, Gary, I'm going to add a little bit more about the financing, the portion of it, is that, a lot of people, because of what has happened over the last year and a half, where the Fed has raised interest rates so rapidly in an unprecedented way, like there's just no way for any operator to be able to underwrite that in their model. Like nobody could project that. And so when you think about everybody's so nervous about interest rates continuing to go up, because we all have recency bias, right? Like something that happened the last year, 6 months, you're going to think we have a tendency to project more of the same, right? But the reality is that we're actually a lot closer to the end of the real estate, or I should say interest rate hiking cycle, for a number of reasons. One of which is that there's a lot of U.S. government debt that is coming due, and they have to be refinanced. And if you just do the math, you cannot do it at these higher rates, right? So it's very simple. When you look at how much interest payments are required at this rate or higher, and then how much the tax receipts are coming in, there's a shortfall anywhere between $4 to $9 trillion. There's just no way, regardless of what Jay Powell is saying on TV. Mathematically, it's impossible. Okay, and so what we don't want to do is compound the mistake of locking in rates for another 5 years or 7 years or 9 years, or maybe not 9 years, maybe 10 or 12, where you're going to be stuck with a tremendous prepayment penalty. I think, Gary, if I remember correctly, we looked at a 5-year fixed agency debt, right? And we figured out that if we were to sell this deal in 3 years, it would cost us $1.5 million in prepayment penalty. So a lot of people don't talk about that. A lot of operators will tell you, oh yeah, we're putting on fixed rate debt. But then what they don't tell you is that, oh, by the way, if we do decide, to exit in year 2 or 3, it's gonna eat significantly into your returns, right? And so combining with our understanding of where we are in the macro environment, in the real estate cycle, we do not want to be locked down and lose our option to be able to exit at the most opportunistic time. So not only do we think that rates are going to be dropping soon enough, and if they do drop, cap rates are going to compress again. And so we want to have the optionality of being able to exit this deal as if it's favorable, right? If the market conditions are favorable, as we think they might be. Now, keep in mind that none of this is in our underwriting, right? We're assuming that we're going to be in a mild recession, maybe even in a noticeable recession. We're not expecting the model is not expecting rates to drop. So all of this would be tremendous tailwind. These would just be additional upside, to our expectations, because none of this is underwritten. But internally, in our research, we actually think that the markets are going to rally. Real estate market's going to take off again over the next 2-3 years.
Yeah,
And
thanks
sorry, Clay, and I just want to make sure that people understand this, that we are doing this on purpose. We do not want to put on fixed agency debt for 5 years or greater, because we're going to be locked into a position that we're going to be stuck with. Not only that, though, because we can refinance, like as we execute on our business plan, right? The revenues are going to go up, the NOI is going to go up. I mean, you saw, Gary showed you that we're going to be able to save at least $138,000 in just the water cost savings alone, right? Cap that out at 5%, and that's a very typical market valuation for Tucson. That's an instant $3 million of value, right? And so as we push NOI, we have the optionality also to refinance, right? If we feel like, okay, our thesis is not correct, we have the option to refinance within the first year or two, with no prepayment penalty, right? So if we need to lock in longer term debt, then we can do it at a lower rate.
Yeah, our rate is not low, so we're not concerned about what the debt service is going to cost us down the road, because we're already paying a decent rate, so we don't have to pay that prepayment penalty. We do have a question here, really good question. There is a general perception that next year is very tough for multifamily investment, and one needs to survive till 2025. But you guys are buying all 5 properties in the next year. This seems very risky to me. Your thoughts? So, thank you for that question. We don't want to survive till 25. We want to thrive to 2025. We think there's a tremendous opportunity, and the pain is not going to be for those that are buying deals now. The pain is going to be for the deals that were bought last year, 2 years ago. Their rate cap is expiring, or they don't have a rate cap. They have floating debt, and they're doing capital calls, and they can't cover their debt service. Those are the deals that people are going to be experiencing pain, and there's been a lot of capital calls for those properties. So we haven't done a deal. This is I think within a week it'll be 1 year since we've done our last deal. So we're quality over quantity. So in the fund, we're looking for 3 to 5 deals, good deals. We're not going to do a deal just to do a deal. We don't do deals for fees. So we found one really, really good deal. We've seen some other really good deals that we like. And so we just need to find 2 other really good deals in the next year, and we're very confident we can find those. So I promise you, we're not going to do deals just to do deals. That's why investors keep coming back to us, because they know, like, and trust us. We're heavily invested as well in each deal, and you're only as good as your last deal. So we are very aware of that. We play for the long haul. So we're looking for really good deals. There's a tremendous buying opportunity that's going to be had. There's trillions of dollars of money sitting on the sideline, the dry powder, waiting to pounce on opportunities. And we're starting to see, we just got a deal yesterday that they need to sell within a couple weeks. I looked at this deal 4 months ago, and it was maybe 50% higher than the price is right now. So you're starting to see some opportunity. It's not going to be, I'm not going to say it's going to be a tsunami of opportunity. But there are going to be some really good deals out there. And with our broker relationships, they feed us deals. They help us win deals. We don't necessarily have to be the highest bidder, because they know we can execute. They know we know our stuff, and we're easy to work with. And like I said before, the whole entire team is investing in the fund as well.
Gary, if I could piggyback off of what you just said, guys, I've been investing for over 30 years. Bought my first stock in 1994, and if there's one thing I've learned, hanging out with a bunch of Wall Street people, is that it really pays to be contrarian. When when you actually become comfortable that it's time to get back in the market, the bulk of that trade is already over. Okay, the opportunity is mostly over. And so, we bought deals when interest rates were super low. But guess what? What that all that did was it compressed the cap rates even more. All that means is that when interest rates are super low, you're just buying at a very high cost basis, right? This is the opposite. When rates are very high, you can buy at a much lower cost basis, right? So anywhere from 25 to 33% off, versus a year and a half ago, peak pricing, right? So, you might have heard the phrase like, marry the property but date the rate, right? And so we're taking advantage of this artificially created high interest rate. Well, high interest rate is not even the right word. Higher interest rate. I remember when my dad's mortgage was like 9.5%. In this higher interest rate environment, this is an opportunity to be able to pick up, some quality properties at lower cost basis, and then wait for the rates to normalize or to go back down, because there's no other choice but to go back down. Then cap rates will compress again, and then therefore we're going to get that tailwind that's not underwritten in our model, right? So multifamily, especially these kind of institutional level, institutional grade, these large properties, they are a favorite asset class amongst institutions. In fact, that phenomenon is about to get supercharged or turbocharged, if you will, because institutions used to favor office space. They love the Class A office property, like what you see typically in like New York City, like the Chrysler Building, the Empire State Building, right? Something that's highly visible. They're trophy properties. They tend to have very well-known corporate tenants that sign 15, 20-year leases. And institutions, they're not looking for the highest returns. They just want cash flow, right? But you all know what's going on with office, right? There's the occupancy's gone down to below 50%. I mean, you saw some trophy property in San Francisco trade at 30 cents on the dollar like a few weeks ago. And so what I'm trying to say is that institutions are now starting to switch out of office, and guess what they're going into? Multifamily. Why? For all the reasons that we mentioned earlier. There's macro trends that favor workforce affordable housing for the foreseeable future. Let's just say at least a decade out, before the boomers, finally, transition to a different place, right? To a different world. So it's never easy to buy multifamily. It's either rates are too low, or rates are really low and you're going to have to pay up the nose, or rates are really high, but you get it at a lower cost basis, but then you can take advantage of the, that tailwind when rates do go back down. And so where it feels really, really uncomfortable, usually that's when the best deals are. Now, we're not saying the best deals right now today. No one's that good. Nobody can time the market that perfectly well. But if you buy over the next several months, 6 to 9 months, you're going to look back in 2-3 years and be like, yeah, I'm glad that, we had the guts, to kind of see through all the noise, right? And just buy on fundamentals.
Great points. I want to add, you said marry the deal. I'd say marry the jockey. We have some investors that saw what we did in Arizona and thought any syndicator can do that in Arizona. And they invested with operators that didn't know what they're doing. They were way too aggressive. They chased the IRR, and they're feeling the pain right now. They've got capital calls up the wazoo with some other operators, and that were just way too aggressive, that were buying everything that they could, and that's not what we do. We focus on quality over quantity, and really conservatively underwrite. I know everyone says they conservatively underwrite, but we really do. We build in lots of buffers. Nothing goes perfectly. We really know the markets. Really gives us an advantage. Michael wrote in the Q&A, $160 billion of debt is coming due in the next 2 years. 60 billion is at risk. 30 billion is unsalvageable, and that will bring opportunity. Absolutely, Michael. We are excited about that opportunity. We're starting to see it now, and that's why the next couple of years is going to be it's going to be exciting.
Yeah, for anyone who's on the call and you know, or is getting the recording after, you know, feel free to reach out. You know, I'm happy to share with you our research, you know, as it relates to macro, to the real estate cycle, and what we're seeing, you know, with the debt markets, you know, and what these numbers are so staggering. And, you know, I don't want you to just, oh, you know, Gary and I are just a couple of talking heads, you know, like I'll give you the citations, you know, so I'll show you where all the data is, you know, if you want to take a deeper dive.
Are there any other questions anyone has? Well, I appreciate you joining us. We had a great turnout. Like Joe said, if you have more questions, don't hesitate. Please go to our portal. Here's one more opportunity to click on the QR code. Jacqueline is there to help you if you have any questions with the docs. We are filling up, so make sure you get in. Take advantage of that bonus appreciation. Don't be the investor that waits to the last second and gets in a bad deal because they want that bonus appreciation. Grab a good deal now. Okay. Thank you so much for joining us. Really appreciate it. Have a great rest of your evening.
Thanks, guys.